Hi, everyone. This is Sam Silverman, Managing Partner of EB-5 Thank you for taking time to join us on today's webinar. Today, we're going to be speaking specifically about urban EB-5 projects. These are projects that qualify as high unemployment TEA projects under the current EB-5 rules. And we'll be specifically talking about why those projects are a good fit for certain types of investors with certain preferences. All right. So first, a little bit about EB-5 we're a leading EB-5 investment fund manager. We've been in the EB-5 space since 2013. We've worked with almost 3,000 families from more than 70 countries. We manage a network of 15 regional centers that cover the continental United States. One of the things that sets us apart from our competitors is a commitment to EB-5 investment transparency. So unlike many of our competitors, we make all of the EB-5 investment documents and financial statements available for investors to review prior to making an EB-5 investment in any of our projects. Our blog and YouTube channel have thousands of videos and posts with lots of helpful due diligence materials and a lot of guides and suggested investment frameworks as investors consider both rural and EB-5 projects and TEA urban projects for investment as well. As I mentioned earlier, I'm Sam Silverman, one of the two managing partners, and today we have my partner Mike Schoenfeld on as well. And I'll let Mike jump in and introduce himself and share a little bit about the background for our company.
Great, thanks, Sam. So as Sam mentioned, we founded the company at this point about 13 years ago and have grown to being one of the largest regional center operators. We both come from more of the institutional side of the world, having worked at the Boston Consulting Group and then at many other leading firms. One of the things that's helped us grow is our philosophy on transparency and also using institutional quality deal analysis to just understand the projects and make sure they meet both the immigration and financial risk objectives that we're looking for. And that's part of the reason for today's webinar is going through some of the specifics on high unemployment urban projects and why for some investors that might be the right choice. Even though there are very substantial benefits for rural projects as well.
All right. And we also have Ahmed Khan, a senior member of our team with us as well. And I'll let Ahmed, a former EB-5 immigration attorney as well, jump in and introduce himself and kind of highlight why today's topic is particularly important for investors that are in the market today considering projects.
Yeah, thanks, Sam. Glad to be here. My name is Ahmed. I'm the Senior Vice President here at EB-5 I've been in this industry for almost close to 15 years now. First as an attorney and also as a regional center executive for two of the biggest regional centers in the space. Yeah, excited to talk today. You know, a lot of my job does involve talking to investors and understanding their needs and what they're looking for as they choose the project to invest in. And I think that, you know, there's a lot of, I think often in this industry, you hear a lot of the positives. I think it's good to understand that there's always going to be pros and cons to every investment. And I think I'm hoping that today we'll shed some light on some of the great things about urban projects and also some of the pain that comes with them.
All right. So as I mentioned earlier, we have regional centers that cover the entire United States. One of the reasons that's really important is it allows us to be geographically agnostic. We're looking for the best rural and urban projects around the country. So wherever they may be, we're able to sponsor them and bring them to market. This is a map showing where many of our prior investors have come from over the years and some of the leading publications where our projects and some of our articles have been featured as over the years as well. All right, so rural versus urban TEA advantages. Ahmed, do you want to kind of walk us through high level what the difference is between urban and rural and just what are the advantages for investors, you know, considering urban compared with some of the other categories?
Yeah, absolutely. So let's start with just the immigration side of things. And, you know, in 2022, when the Reform and Integrity Act was passed, Congress basically set aside visas in different categories depending on where the project location was. And part of it was to incentivize investors and to file into rural TEA projects. And so what they did was, one of the big differences between all these categories was they gave rural targeted employment area projects priority for processing. Okay, that's kind of unique to that category. But they also set aside visas for urban TEA projects that qualify through higher unemployment than the national average. And they incentivize investors in those projects as well by offering it at the same amount as rural TEA projects, which is 800,000. So there's definitely a financial advantage, by choosing an urban TEA project versus like an unreserved project, in that you're still coming in at that lower $800,000 amount. But the two kind of distinctions that we've seen over the last 3 years with urban TEA and rural TEA projects is that, one, rural TEA projects definitely get processed at a faster speed. Sometimes it's a lot faster, sometimes it's a little bit faster, but it's been pretty much across the board a shorter timeline to approval in a rural TEA project. And urban TEA projects also get less set-aside visas. So every year, about 2,000 visas are set aside for rural projects, whereas 1,000 are set aside for urban TEA projects. Now, there's more than just 1,000 and 2,000 available per year based on rollovers and trickle-down visas and things like that. But for our purposes, this is really just to illustrate that, from an immigration standpoint, there are some key differences to highlight between urban TEA or high unemployment area projects and rural projects.
All right, perfect. All right, so let's talk about the most recent February visa bulletin and what this means. I'm sure many members of our audience are familiar with the visa bulletin, but as a quick refresher, Ahmed, why don't you walk us through particularly the last 4 rows that relate to EB-5?
Yeah, exactly. So if you look at the visa bulletin and you're kind of, stuck in a backlog in maybe a different category, and that's why you're considering EB-5 in the first place, you'll see that, one of the big advantages for EB-5 applications is that 3 of the 4 categories are current, which means that you can file and do a concurrent filing right away. And this really does help to assuage some of the pain of the longer processing times that we've seen in high unemployment. When you're able to file an adjustment of status concurrently with your application, with your EB-5 application, you are able to get a work permit and a travel permit typically in just a few months, and those will last you until the time that you get your conditional green card. So although, high unemployment projects don't enjoy priority processing, they are current, just like rural projects, on the visa bulletin, which does offer a distinct advantage from, let's just say, unreserved, which is still backlogged for India and China, and allows investors, if you're filing in an HUA or high unemployment area project, to file concurrently and get the advantages of an adjustment filing.
Got it. Okay, that makes complete sense. All right, so Mike, do you want to walk us through some of the recent data we have about EB-5 investor demand and kind of what that says about the urban category historically and kind of what we're seeing now today?
Yeah, and I think it's great that we have data. It's lagging behind about 6 months now, but we do have a very significant amount of data of by country, by category filing and over time. And what we've seen is that in the recent history, India and China has shifted more towards rural, although it's still barely in favor of rural for the 2 major filing countries. But for the whole rest of the world, filings have definitely leaned towards the high unemployment areas instead of rural. And later we'll get to, some of the reasons why we think that's the case. But generally what you can see is overall, it's about 50-50 in terms of the split when you look at it across. But the 2 largest countries of India and China lean slightly more rural for those benefits versus the rest of the world.
All right, and let's talk about the approvals, Mike. What are we seeing in terms of approval differences between the 2?
Yeah, and this is one of the most telling things over time, and one of the reasons why you'll see even those countries not at risk of visa backlogs going for rural deals is because the processing time is so much shorter for these rural projects. So the chart on the left just shows the total volume of approvals in rural and urban. And remember, it's been about 50-50 in terms of filings. And you can see there's 5 times as many adjudicated applications on the rural side. But in terms of the actual approvals, it's about the same percentage. An extremely high percentage of these post-RIA applications are actually getting approved, much higher than historical averages. So that's a really good sign that as long as you work with a good attorney and have a clean source of funds, and over 95% I-526s are getting approved. But what you'll see is that the reason that rural has so much higher of a pure number of approvals is because of that shorter processing time. So main difference is speed. It's not really about whether one or the other is more likely to get you approved. Rural versus urban, neither one's more likely, especially if the project is already pre-approved. Then it really only comes down to your source of funds. But in general, you will get approved more quickly in a rural project.
Yep, exactly. And we can see that here on the left side with almost 5 times as many rural approvals as urban. So just priority processing really is a material difference in terms of getting your application, approved quickly. And we're seeing a lot of those rural applications get approved in kind of the 9 to 12 month window. All right, so shifting gears here. So why investors prefer developments in urban areas or high unemployment areas? Go ahead, Mike.
Yeah, so when you look at the initial data, you'd say, why would someone choose an investment in a high unemployment area when rural is getting approved so much more quickly and processed more quickly? And especially for Chinese and Indian investors, the chance of a backlog or the length of the backlog will be materially shorter in that rural category. So here's a summary of why some investors would choose the urban high unemployment deals and why historically before the RIA, a vast majority of deals were located in what would be urban high unemployment areas, and not nearly as many were in the rural areas. So a lot of it just comes down to density. When you're thinking about a project in a major city or a secondary market, there's developers that have done dozens of deals in that exact area with the same builders. There's exact comparable projects. So if you're building a new multifamily project at a street corner, you can look around and within 5 miles have many comparable deals where you can see generally what things are going to rent for, what the occupancy will be, what recent exits have been, and just have a really good grasp of what the fundamental numbers look like for that project, because there's a lot of density and a lot of competition, but it's also a bit of a commodity in that generally things are stable in these types of market. The next key factor here is just execution. It's a lot easier to build in an infill project or on the outskirts of a major city as you're just filling in a vertical structure than it is to complete construction in rural areas. It's not always the case, but generally construction in rural areas is going to be more expensive. There's less labor available, and it may be more expensive to get the utilities and things needed compared to an urban infill project. And that leads to shorter development timelines as well. In urban areas, you can find very cookie cutter or bite-sized deals that are very easy to rinse and repeat and get in motion. Versus quite often in rural areas, you are going to have longer duration master plan community projects, something that takes longer to work on, entitlements take longer. Everything does take a little bit longer to execute and complete in rural areas, especially if you're doing a larger project where there's seasonality in terms of the construction. And kind of the last piece of it is just that in urban areas, there's a lot more jobs and amenities around. It doesn't have to be a destination location, where in rural areas, generally it's going to be a destination that people are going to, versus in urban areas, it's actually where people live and work already.
Yeah, and
that makes sense.
One thing I'll just add to that, because everything that Mike just said is really, it should give investors a lot of perspective on, I think what it gets often generalized as, urban projects are safer than rural projects. And we've said this multiple times that, the safety of a project has more to do with the way that it's structured, Obviously, there's a lot of other factors that are to consider, including the ones that are listed here. But it isn't necessarily true that just because a project is in an urban area that it is automatically safer. So it's important to understand that although these are a lot of great advantages that urban projects have, and they offer, because of these, we can offer more variety and find often a bigger kind of spectrum of types of projects in urban areas. It doesn't necessarily mean that urban projects are the only option that investors have if they're concerned about safety of capital. It's important that aside from this, you're still looking at all the other things that we talk about in a lot of our other webinars about what makes a project safe, and just the location itself is not enough to do that.
All right, so let's take a look at a map to get an idea of where some of these urban projects are located. So looking at this list, we can see 15 different EB-5AN culture projects that we've worked on over the last 13 years. And you can see most of them are kind of located on the coastal areas, the more dense kind of coastal parts of Florida along the southeast coast there, and then on the west coast, kind of around Tampa, Sarasota area. And that makes sense. That's where a lot of the development has focused on the water in the higher population areas, close to Miami, close to the Tampa metro area. And we've had a lot of success with those types of projects over the last 13 years. And taking it a step further, when we look at specifically some of the financial comparable statistics for some of the projects we're working on currently, Terracea being one of them, we can see that there's a lot of comparables that support the rent per square foot for the Terracea project and a number of the other urban rental projects that we're working on. And that's just another reason, as Mike mentioned earlier, in these urban areas, there's a lot more data, a lot of other comparable projects. So it's a little bit easier to underwrite and make assumptions that can be easily validated by third-party data. Here's another example of that. When we look at some of the recent comparables for apartment buildings that have sold, we can see pretty clearly that the assumptions for the Terracea project, one of the urban EB-5 projects that we have open currently, are pretty much in line with market comparables over the last 5 to 6 years or so. Same thing goes in terms of execution. You're in a city, there's dedicated sewer, electric, power, utilities, everything's already right there. In a lot of these projects, particularly our Boynton Beach project, Terracea, and Alton Brandon, these are really urban infill projects where all the other land surrounding the project's already been developed. And so all the key underground utilities infrastructure is already in place, which means it's a lot cheaper, cost effective, and faster to bring in utilities and develop kind of that last remaining parcel of land where our urban projects have been located historically. And you can kind of see that same thing here. You've got a lot of established healthcare, shopping, metropolitan areas, businesses, all within a very short drive of these project locations. A lot of population there, so it's a lot easier to say, yes, I have confidence that this property is going to be able to rent, and here's what I think the rent assumptions are going to look at. Also, what that means typically is that the project investment time frame from both overall completion and also EB-5 repayment tends to be a few years shorter. So because you have access to more building companies, you're in a metro area, it's easier to source labor, it's easier to get permits, and you already have all the utilities like we talked about. A lot of these projects, even though they're fairly large, can get completed in 3 to 4 years. And so that means EB-5 investors can be repaid in 3 to 4 years, sometimes even sooner, depending on what stage of the project they join and their funds are made available into the project. Mike, do you want to talk a little bit about some 956F timing and how we're seeing that vary across our multifamily portfolio?
Yeah, so on this slide, we're showing our 27 Form I-956F approvals that we have as a company post RIA, which I believe leads the industry. And along with the many rural deals that we've done, we've also structured several urban deals, multifamily deals with a large developer in Florida named Coulter, where we've done dual offering debt and equity for the same project to allow investors a choice of whether they want to be in the secured debt portion of the project or earn a higher return with some of that equity with the preferred return. And as you can see, we've been doing about one of these a year, and it's actually gotten a little bit faster for the approvals each time that we filed. But the approvals for the 956F have actually been in line with our rural deals, not really any material difference with the rural deals. And as you'll see on here, the first green box is our Boynton Beach project, which is completely full. Construction is nearing completion. It looks really good, and we'll see some pictures. The middle one is our Terracea project. We're nearly full on this deal on the EB-5 part of the project, and construction has advanced with several of the buildings already kind of topped off, and we'll look at those pictures. We do still have a little bit of room in those, and they are 956F approved. And then the most recent project, which we haven't opened up yet for investment, but we will in the very near future, which we did just receive 956F approval on pretty recently, is our Alton Brandon project, which is very similar to these other two deals and is starting construction in the next 2 months. So historically, the 956Fs have been approved in similar timelines to the I-526Es, but I will say just based on overall data, 526Es are going to be processed as urban projects, and look at those timelines.
All right, great. All right, Ahmed, do you want to walk us through these three different urban multifamily projects we've done with Coulter and kind of where we are at in terms of each one?
Yeah, absolutely. And I think that, this really illustrates the point that you made earlier, Sam, about having, something to look back on or other examples of very similar projects so that investors can feel very comfortable with the project that they're now investing into. And this is kind of the big advantage of working with a developer like a Coulter. That's a proven developer, been there for multiple decades and has a track record of great success, is that once they choose an asset class that they can kind of repeat over and over again, then investors can look to their past projects to feel very comfortable about upcoming projects as well, since they're going to follow a lot of the same model. We've seen that, even on the rural side with Rocky River and Twin Lakes, and even Spring Haven, which is another high unemployment area project that we have, where Coulter has the model of building homes for 55 plus active adults and being, very, very successful in that regard. And, investors feeling very, very safe as a result because they're seeing a model and then being replicated. So we've got the same thing with these high unemployment area deals that Coulter offers. And to me, this is the best bang for your buck in EB-5 right now, right? Investors are able to work with an incredible developer in the Coulter group who's paid back tens of millions of EB-5 dollars to previous funds. This is, an asset class that is proven in multifamily apartments. There's a very predictable and repeatable kind of structure here in terms of both building and then exit for all of these buildings. And probably the best thing for investors is the short development timeline, right? We're able to get the 2 years that we need for full job creation from an EB-5 perspective. But that's it. It's about a 2-year kind of timeline from beginning to end, maybe a little bit more. And it gives the developer ample time to then stabilize and ultimately conduct a sale or refinance and pay the investors out in a very short overall period of just 3 to 4 years. Being I-956F approved to me is just the cherry on top. And, when I look at these projects, Boynton Beach, project that we filled up last year, and now you can see that it's very far along. Terracea is about 9 months ahead of Boynton Beach, or I guess behind in terms of development timeline. And you can see they've made incredible progress there. Brandon is going to slot in and look very, very similar in just a few months' time. So It's predictable. You can look at the past projects and understand how they've gone and see the timelines along the way. You can even go on our blog and see the regular updates that we provided to investors along the way of the progress, and feel very comfortable about what your project is going to do and how it's going to look in a few months. And to me, that predictability is a lot of the comfort that some investors are looking for. While rural projects really do offer a lot of that priority processing and ease of getting your green card in terms of timing, I think what a lot of investors struggle with rural projects is often they're one of a kind. They're hard to compare. They're hard to sometimes even imagine for investors who aren't familiar with that locale or that area. And so those investors often turn to HUA projects instead because they're more familiar and more comfortable. And at the end of the day, it's their money that they're investing, and you've got to feel comfortable with it. So, if you can take out one of the variables in EB-5 in a process that's obviously fraught with many, many variables, it's a huge advantage to those investors. So what I typically tell investors is, look, if your main priority is to get a green card as quickly as possible, right? And that last part is important, not just getting a green card, because either type of EB-5 project will get you that, but it's, I need it as soon as possible for XYZ reason. Maybe you've got a kid who's aging out, maybe, a job or something like that, or your career choice depends on having a green card in hand. For those investors, rural projects make a lot of sense. But if you're an investor who's looking for a balance out of the overall process, you want more predictability, you want to sleep a good night's sleep for just a 3 to 4 year period, and under the new rules, still be able to get your money back while continuing the immigration process down the road, these HUA projects specifically that are able to get investors paid back in a short 4-year timeline or sooner are an excellent, excellent way to kind of not game the system, but take advantage of the new rules under the Reform and Integrity Act and get the most out of this process of securing your overall future while also getting your money back in a short period of time, while working with a big name developer that's got a great track record of success in projects that you feel very, very comfortable with because they're a proven model.
Perfect. Thanks, Ahmed. And I can't emphasize enough just the importance of working with an established developer like Coulter that's worked on over 200 projects. They've never failed to finish a project or to repay a loan in almost 30 years. So very extensive financial track record doing this exact type of project in Florida. So, and also with them we've done over 30 EB-5 projects. So a lot of past success in both the asset class, the location, the developer, and EB-5 specifically. So those are all factors that you want to look for, and ideally have extensive prior success in all those different dimensions. And this is just another slide here kind of showing the similar timelines and kind of where we're at in terms of the exit and construction periods for each of these projects as a comparison point. And again, another comparison, this time on the financial side. Unlike many of the other companies in the space, we're very analytical, number driven. Mike and I both spent years at the Boston Consulting Group, and we really like digging into the numbers and illustrating them for investors to be able to see exactly how the projects are financed and what the differences are across our portfolio. And as you can see here, these projects are all kind of in the $70 to $90 million range. And very similar kind of percentage-wise breakdown for land, EB-5 amounts, hard, soft costs, etc. All right, Ahmed, do you want to walk us through the loan versus equity options and kind of why we have both options available for clients and what may be a better fit for some versus others, depending on kind of personal immigration and financial risk tolerance?
Absolutely. So I think that the first thing to understand when you talk about debt versus equity or equity versus loan, however you want to phrase it, is that you should always avoid generalizations that you hear in the market. I think I hear a lot of people say, oh, you should never do an equity deal because it's too risky in EB-5 and you're just never going to get your money back and things like that. It's just not true. We have equity deals that have already repaid to investors with Coulter. And if you step outside of EB-5 and look at, just normal investments that you might be pursuing in your, as just a regular investor, a lot of the offerings that will be available to you would be on the equity side versus debt if you're not, an institution. So you shouldn't write off equity just because you've heard somewhere that it's more risky than debt. Now, is it inherently more risky? Yes. Does that make it very, very high risk? Not necessarily. And I think that's kind of the first thing to understand is, people get scared about things that they don't normally understand, but taking the time, especially when you're spending this kind of money on EB-5, to understand all the different options that are out there and what the pros and cons are of each are very, very key. So just in a nutshell, what is the difference between loan and equity? Loan means you're providing debt or you're providing a loan to the developer. They are giving you a form of collateral. In this instance, Coulter provides us with a loan repayment guarantee that's collateralized by other assets that they've accumulated and own over the years, versus equity, which is exactly what it sounds like. You're essentially handing the developer money without some form of underlying collateral. But because you're basically participating in the project alongside them, you also get a higher return on your investment than you would with a loan. Okay, so the way that we structured these deals specifically is, one, because we feel so comfortable with the way that Coulter structured these deals and is able to build and ultimately sell these types of buildings, we offer investors kind of a unique opportunity to join in the equity investment and earn a much higher return. So because you're taking slightly more risk, you're also getting a higher reward. In our case, we offer a 5% preferred return. This accumulates on an annual basis and is paid out at the very end once the project is completed and a sale occurs. So a good way to think about this is if your money is invested for about 3 years, you would put in $800,000, and then 3 years later, you would get back about $920,000. I'll use Terracea as a really good example of kind of what the risk really looks like. Remember, we're talking about a seasoned developer, a $40 billion developer that doesn't go to the drawing board when they're looking at their next project and say, okay, guys, how can we avoid losing money, right? They're more interested in, hey, how much money can we make? And is this deal even worth our time, right? Coulter's far more concerned about hitting their target profits than they are about will or will not this project be successful. They've reached that kind of stature. So for our equity offerings, let's just take Terracea again as an example. That's a $70 million project. And as long as Coulter is able to basically build, rent, and sell the overall project for about $67 million, EB-5 investors would still get their $800,000 back. So these are easy numbers to kind of work with. It's a little bit more complicated than that, but generally the idea is correct that, if Coulter is able to sell the building that they've just built for the same price that they built it for, EB-5 investors are going to get their principals back, right? Now, it looks even better. So it's a $70 million building, Coulter's expectation is to be able to sell it for about 90 million, maybe a little bit higher. If they even miss that mark by, let's just say 10 million, let's say they end up selling it for only 80 million, that's a pretty big loss for Coulter. But guess what? Our equity investors still get their full 5% return. In fact, they could go as low as 76 million and investors could get their 5% preferred return. So, you shouldn't always listen to the noise that, all equity offerings are just really, really unsafe. There are levels to it. Inherently, any equity offering will always be a little bit more risky than loan. But when you're working with a developer as seasoned and with as good a track record as Coulter, it's a really good opportunity to say, hey, I'm locking my money away for 3 years. I wonder if I can generate some return as well and kind of soften the blow of the opportunity cost. And these projects are the best ways to do that.
All right. And just to kind of illustrate that difference in investment period timeline that we talked about earlier, typically in our urban projects, we're targeting about a 3-year total investment period for our investors on both the debt and equity side. And when you compare that with a lot of the other projects, particularly rural projects, they tend to have a little bit longer, 4 to 7 year investment period timeline, because again, it's typically a longer process to build in a rural area. There's less people there, takes longer for the project to get going, and also to be absorbed into the market. Whereas in the urban projects, it's typically faster to build and faster to absorb into the marketplace. And here, just as a quick kind of return illustration, comparing both a debt option in one of our debt projects versus the equity option with a much higher 5% return. You can see here that an equity investment is going to pay significantly more than the standard investment, basically 20 times difference, and even significantly higher than the current 3-year US Treasury. And on the loan side, again, in our Coulter loan projects, our loans are structured a bit differently from many of the other competitors, in that instead of having your security for your EB-5 investment tied just to one property with one address, where if things don't go well at that one address, then your funds are going to be in danger. With Coulter, because they're such a large diversified company, we've been able to negotiate for a parent company repayment guarantee, securing the outstanding balance of the EB-5 loan with a much larger diversified parent company that owns many assets, in some cases over $1 billion of assets in those entities, that are guaranteeing the EB-5 loan spread across 20 plus projects. And so it just really reduces the amount of risk in terms of the repayment of the funds, because the success of all of those projects is kind of tied to the repayment. And so it's just a much lower risk situation for investors. All right, Mike, do you want to walk us through some of the different 956F approved projects we have?
Yeah, and I think one of the things that makes us most unique is that generally we wait to launch a project until we have the 956F approval. We know that investors have many different things they're thinking about as going through this process. $800,000 is a lot of money. You want to make sure that you get the green card. There's an opportunity now with the Visa Bulletin Current where you can adjust status, and you don't want to risk losing your place in line or losing that adjustment ability in the future. So we tend to wait for a project to be 956F approved before we launch. So as we're looking at our portfolio of only urban TEA approved projects, we have a couple different flavors. The 4 on the right are all the types of deals that we just spoke about our multifamily projects. The Terracea multifamily, which has both the loan and the equity model, and is nearly full, and construction is very well progressed. That's on the bottom, so those will be closed soon once they're full. And then next in the multifamily family would be the Brandon multifamily, which is very similar to what Terracea is, pretty close by, and just received the 956F approval, and construction should be getting kicked off in the very near future. So that's a great option if you're still earlier on in the source of funds process, or waiting 30, 60, 90 days to file. I'd say that's a good one to look at. We do also have 2 other interesting projects within the urban category. Our Springhaven project on the bottom left is a large master plan community, a Crestwood neighborhood by Coulter, where all jobs have already been created for every EB-5 investor that can go into the deal. The neighborhood is very far along. And that one, you're essentially choosing a little bit longer duration of a deal to go into one where the jobs are already created for you. It's already stabilized, and it has that soft, strong type of collateral structure. And then the last urban deal that we have on the top left is equity in a condominium project with Coulter, our Corey Landing project. We've been holding this on the sidelines until construction gets very well underway, but at this point it is fully pre-approved and similarly has a 5% annual preferred return, and is very similar to the last equity condominium deal that we did with Coulter, the Solterre project, which has fully completed and repaid. So there are 6 great options, 2 of them almost sold out, 2 of them about to launch. and then the other's underway, where if you're interested in an urban TEA deal for any of those reasons, these are all ones that meet different criteria that investors might have, whether it's duration, return, asset class, state of construction. And it really just depends on investor preference for which one makes the most sense.
Perfect. All right. Thanks, Mike. All right. So before we wrap up, just two kind of high value articles that we have on our site that I want to highlight. The first is 4 key factors to avoid losing money in an EB-5 project. This is a post that's gotten a lot of traction on our site over the years. And then a second post on the right here, Bill of Rights, 10 rights every EB-5 investor should have. These are 2 posts that I would strongly suggest potential investors take a look at, regardless of whether you're considering urban or rural projects that have a lot of really good kind of high quality information that really should apply to any project that's. All right, Ahmed, any final thoughts before we conclude?
No, I think that this was really informative, hopefully, for everybody. And yeah, I think that whenever I speak with an investor, my first question is, what are your priorities? Tell me a little bit more about your situation and what you want out of this process. If the answer to that question is, I want to secure my green card and my future here in the States, while also, not lose, I want to minimize my opportunity cost for my investment, then the high unemployment area projects that we have available are a great way to do that. They're all 956F approved, so you're taking very little immigration risk at that point. They're all under construction for the most part, so that you're going into a project that's already underway. And they're all with Coulter, which is just an extremely seasoned and excellent developer with a great track record that investors can look back on and feel comfortable putting their money towards. So yeah, I think these are some great options. I would encourage any investors who are looking at high unemployment area deals to reach out to us generally and ask us more questions, and I'm happy to talk more about these projects. And some investors who are probably more inclined towards rural to also consider these investments as a possible way to secure their green cards and come away from this process very, very happy.
All right, perfect. Thank you, Ahmed. And I would say, any investors looking to get more information on any of the projects we talked about today, or the 5 or 6 different rural EB-5 projects that we have available as well, please reach out to us. You can use the QR code on the screen there to schedule a call. And we're happy to get you access to all of the investment documents, business plan, PPM, all the investment agreements, and access to the financial statements as well. So you can take a look at everything and also come out, visit any of the projects in person. So with that, thank you for taking the time to join us today. And we look forward to being in touch with you.
Thanks, everyone.
Thank you, everybody.